You can give back in a multitude of ways. You can give your time, your talent, or your treasure.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. We have a great show today. This week, we are joined by Vince Vitale. He is the Director of Equity and Alternative Strategy Research at Advanced Capital Management, an independent RIA headquartered in Southfield, Michigan. Vince is a Chartered Alternative Investment Analyst, CAIA. What's up? He's also a CFA, and in fact, he's the president of the CFA Society of Detroit. So we're going to talk investing, we're going to talk charity and how to give back. We're going to hear about the Junior Achievement Stock Market Challenge, which is sponsored by the CFA Society of Detroit, and more. Vince, thanks for joining me on the podcast.
Thanks for having me.
All right, so I thought we'd start with Advanced Capital Management. If you could tell us a little bit about the firm and about your investment process.
Sure. So Advanced Capital was started back in the late 80s by three former AT&T Treasury employees. So they managed the pension money for AT&T. They left there in the late 80s to go run pension money by themselves. But they had no track record, so no institution would give them money to manage outside pension money. But luckily for them, that's basically AT&T went through a huge restructuring, right? So there was all the baby bells and there was lots of buyouts. And so employees knew they started this firm and they were given lump sum pensions. And so they were like, hey, you manage our pension inside AT&T. Can you help me with this decision and, manage my pension outside of AT&T? And they became more of an independent sort of pension manager for individuals and, today a wealth manager, right? So they did a lot of financial planning and manage these people's pensions outside. They were really sort of forward-thinking, I think, back then. They started their own mutual funds. Back then, everything was commission-based. So they started their own no-load mutual funds to manage the fixed income side and equity side. So it was a very low-cost way to manage people's money. And then they pair it up with some commission products to have diversification. Fast forward 30 years here, and that's what we are today. We're a full-service wealth management firm, primarily focused on, the retiree community, still have a huge connection to AT&T employees and helping them, work through their pension decisions or retirement decisions. And I like to look at us as an individual pension manager, right? Our goal is to ensure that clients' money is there for them, providing an income stream for their life, and so that they don't outlast their money. So a lot of our investment philosophy and strategy is about risk management.
Are the mutual funds still around?
They aren't. So we closed those down in 2015, and that was really a decision that had to do with sort of a fundamental shift of how we manage money. We moved to more of a multi-manager approach. We've just felt in this day and age, we couldn't compete with the large organizations that had just these immense, deep research, benches. Think of whether it's Vanguard, T. Rowe Price, Fidelity. They just have so many more resources and so many different strategies that we felt we could really do a great job of evaluating managers. So, we've been doing that throughout our history, but even more so over the last decade. And our experience managing money in general on the individual equity side and fixed income side, it gives us the ability to really understand how a manager's thinking, what works, what doesn't. And we've had great success of finding good active managers that actually produce alpha.
So what is the framework that you use to evaluate managers? Is it asset class? Do you start with the asset allocation and then pick the best in class for each bucket? How does that work exactly?
Yeah, so as I said, we manage money for individuals, but it's across the spectrum. So it's our advisors have the ultimate relationship with the clients. We build solutions for our advisors to utilize with their individual clients. With that being said, we start with sort of a risk-based process across our asset allocation models. So it's conservative all the way to aggressive. And so that's your starting point. With that, we utilize diversification amongst asset classes, whether it's U.S. equities to international to certain bond sectors, focusing on sort of correlations and understanding that in risk periods you're going to have increased correlation. So we do focus on trying to minimize that to really provide real diversification over time, when it matters. And so from that standpoint, we start with that with our base model, and then we fill the holes, right? So then we start digging into the managers. And from that standpoint, our process really sort of goes through a 7-step process. We have an initial screening process, just like I'm assuming most big consultants do, really whitting it down when there's 28,000 mutual funds out there and 3,000 ETFs in every slice and dice strategy out there, right? So we have a way to sort of funnel that down from risk metrics and sort of a consistency approach. It's a model that I built that really looks at rolling 3-year periods over as far as the manager's performance has going. Obviously, with a startup manager, you have to have a little bit more trust and really understand their process and believe that something's going to happen. But to weed down that field, at least from everything that's out there, we start with this rolling 3-year process. And our focus really has to do with the long term. I think there's a lot of articles, whether it's Vanguard or Morningstar, showing that people aren't that great at picking active managers, right? And they never really realize the alpha that an active manager has. And part of that reasoning is they invest with a manager after they've had good performance, right? So a 3-year number comes out, a 5-year number comes out, and they're 5-star manager, and they just had a great performance. A lot of that has to do with their strategy. The strategy was in favor, right? And that's what happens with a lot of good managers. It doesn't matter. They're going to go through lulls as well. And the only way you get their alpha is by sticking with them. So you have to be a believer in their investment strategy and process and not give up on them at the wrong time. So we really focus on when we enter and allocate money to a manager that we're going to be with them for a long time to actually get their alpha.
The cyclicality of different investment factors is so important. I mean, famously, Warren Buffett was behind the NASDAQ in 99, 2000 by, I can't remember the number, but an obscene amount. I mean, tens of percentage points. I think it was something close to like 100% over a certain period from, peak to trough of the NASDAQ run in 99, 2000. And again, we're seeing that today. I mean, anybody who's a value manager, no matter how good you are at being a value manager today, you're going to be underperforming momentum, or you're going to be underperforming, different factors. And the cyclicality of these factors is so crucial in understanding the performance of active. We hear so much about passive now, about, it's become, from Bogle alone trying to convince the world that passive has merit to now where it's almost conventional wisdom that passive will beat active. But everyone talks about it on the broad level. Broadly, you take an average of all the active managers, they underperform by a small amount, but they underperform the broad, passive benchmarks over time. But that doesn't mean that within that there aren't outperforming active managers. And in the ETF space, we've seen a few managers, Kathy Wood at ARK, for example, in this market cycle has done incredibly well. So there's really, you really have to make the case on 2 points, right? One is that the active managers themselves can outperform, and 2 is that you can select the right active manager. That's a hard case to make in an environment where so many people are touting the benefits of passive, and where over the last few years, maybe it's a self-fulfilling thing, but over the last few years, passive has performed well. How do you make that case?
Yeah, so I mean, I think part of that, right? Yeah, passive has had a phenomenal run. There's nothing wrong with passive, right? And I think a lot of times indexing is perfectly fine. We take an active approach from the standpoint that, it's about risk management. So everything's not always about just beating the actual total return, right? So we do look at risk-adjusted performance. Some people say, hey, you can't eat Sharpe ratio. Well, in a income drawing standpoint for retirees, you absolutely can eat Sharpe ratio. And the fact that it will allow your portfolio to last longer if you're minimizing those drawdowns. So from that standpoint, we do pay attention to that and how we sort of feel an active manager is adding value. So it's not just, hey, XYZ index, whether it's Russell 1000 value or the Russell 1000 or the S&P 500, did the manager beat that? How did they beat it, or how did they, slightly underperform, right? And understanding the merits of the diversification, meaning today, the NASDAQ, like you mentioned, 5 stocks make up 50% of that index. So 5 stocks are really driving the performance. And today, in the S&P, same thing, 5 stocks, I think, are now at 25% of the index, highest ever. And similar to 2000 or the late 90s, I think there is this momentum factor in crowding in a lot of names. And part of it has to do with the dynamics of the interest rate environment, and that growth can persist forever, right? And the ability for these companies to grow earnings forever at an outpaced level. But I think over time, just like all good growth companies, their ability to sustain the level of growth relative to where interest rates at, there will be a mean reversion at some point. And what has worked for the past, going on a decade now, a little bit longer even, will slow down. I think forward returns on these names is going to be less than what has historically happened here. And we'll find out, I guess, over the next decade. But I think you have to be cognizant of buying stocks that are trading at 40 times earnings.
Right. I mean, allocating to big tech sounds great if you also have a time machine and can go back 3 years, then all of a sudden you could do great, but you're projecting forward. And, you talk about the concentration. Just yesterday, Apple alone, the market cap of Apple passed the combined market cap of the entire Russell 2000. The entire Russell 2000, one company. It's incredible. So, I think there are a lot of people tricking themselves into thinking that they're diversified. And, why not? It's working for them now. There's no problem. But there, very likely will be a day when it's not. And all of a sudden, they're going to remember diversification. They're going to remember, valuations and fundamentals. And, those who didn't have the foresight to put in those risk management factors ahead of time are going to, very likely pay the price.
Yeah, I mean, I think at the end of the day, everyone wants to make as much money as possible, but not all people are actually fortunate enough to implement that strategy. And so you have to remind clients sometimes of what their true objective or goal is, right? So our goal isn't, for most retirees and the bread and butter of most of our clients, isn't to grow their portfolio to the moon. It's make sure you don't run out of money. And our goal is to make something above their rate of, withdrawal rate plus inflation. So if the withdrawal rate's 4 or 5%, our goal is to try to make 5, 6%, 6-7% a year. It's not to keep up with the S&P 500. And even on the equity portion, so we obviously run, multi-manager portfolios, multi-asset class from the standpoint of, equities and bonds. And from that standpoint, we really are looking at trying to so let me go back. So we're really trying to earn a couple percent above their withdrawal rate, right, to keep up with inflation. And you don't need to exactly keep up with the S&P 500. We try to remind clients of that as well from the standpoint of, today people are asking, why do we own small cap stocks? To your point earlier, that Apple is as large as, the entire Russell 2000. They still produce a good return, and their valuations aren't looking quite as frothy as large cap stocks. So I think their forward expectations can add value to a client's portfolio. And so we're always cognizant of not trying to crowd and follow what's working today, but to remain balanced.
Yep. And how do you manage those withdrawal rates and inflation in a low bond yield environment?
That's, I think, our toughest problem right now. I think everyone's faced with that problem. I think that's also what has bolstered equities for sure. The old Tina, there's no alternative, because yields have been so low for so long. And with the Fed coming in and buying corporate bonds and high yield bonds, even spreads have compressed to all-time tights. So, where we just had close to all-time wides in March, especially in high yield, today they're back to all-time tights, within a matter of 5 months, which is historically unprecedented for that kind of collapse in yields. And they're basically eliminating a lot of risk. And so when you think about that too, if they're eliminating risk, it's lowering your risk premium. So if all assets are going up in value a ton, it's because there is no premium to be had by taking on extra risk. So that in of itself will cause lower rates of return into the future.
At the end of the day, your clients, you said mostly retirees, but you have all kinds of clients, the ones that don't closely follow the markets, the ones that aren't nerds like us and don't, get into factors and different aspects of the market. How close are they to the strategies that you employ? How do you get calls from clients that say, how come we're not in Tesla? Do you get, are they that on top of things, or do they just kind of sit back and trust that you have it under control and let you guys manage?
I think the majority of our clients trust what we're doing. We try to communicate as much as possible to our clients, and hopefully they have picked up enough over time. You're always going to have clients that want the latest and greatest, whatever's in the news. And for those clients, there's a conversation to be had more on an individual level with the advisor and the client. So if they want to add certain individual stocks to their portfolio, they can. But that's not broadly how we manage, we'll call it the collective group of our risk-based models. they may own Tesla, but that's through, an active manager, right? If an active manager in their portfolio feels Tesla's, a good stock to own, they'll own it, right? And we let those decisions fall to the active managers. And it works well that way. Our broad thing to create returns for our clients is to make sure they're invested, because we do believe long-term being allocated to financial markets, the capital markets, is the best way to earn wealth over time and produce a reasonable return, especially in an environment where, back 30 years ago, you could have, put a retiree's money in a 30-year treasury and got 7-8%. Your job was done. You risk-free asset, right? Backed by the government, you get 7-8% a year, more than willing to, cover withdrawal rates of 5% a year, and you keep up with inflation, right?
Fees were better too.
So
we got paid better for doing it.
Right. So $1 million portfolio would give you $70,000, $80,000 income. Well, today, a 30-year treasury is 1.4%. So that same $1 million is going to give you $14,000. Not many people can live off of $14,000. So you're forced to go into other asset classes. And I think large companies have been able to benefit from their size and scale, right? They can borrow money at extremely cheap levels, and they can sort of add dividend value through buybacks, right? And I think it's sort of, a lot of people complain about buybacks, that it's, engineering earnings and everything. I think if you're taking on too much and excessive debt, yes, because you now owe money back. But if you're using it through mainly cash flows, it's a tax efficient way to distribute a dividend. If you think about capital gains are a lower tax rate than dividends. So if you're buying back your stock and you're having capital appreciation to your share price, well, great. So I think from that standpoint, you're getting that yield, but in a different manner by owning equities. And I think that's a good way to measure earnings yield or free cash flow yield on individual businesses versus just PE. And I think a lot of the growth names still have attractive free cash flow yields. And when you look at earnings yield, a lot of people compare it today to the tech bubble. When you look at back then, your earnings yield was 2-3%. Similar today, I think I just looked today, it was like 3.1% is the overall earnings yield on the S&P 500. That's still better than your 30-year treasury at 1.4%. Back in 2000, you had a 6% treasury rate and an earnings yield of 3.1%. So it was inverse. Not to say that we need to go all the way down to 1.4%, but from an investment standpoint, as I said, rates of return going forward may just be lower. But I think the businesses that are built today, they're global in nature and they're diversified in and of itself. I mean, you have Apple selling everywhere in the world. You have Google selling everywhere in the world. You have Amazon selling everywhere in the world. That's beneficial to a business. I mean, they to an extent are monopolies, and therefore they deserve to trade at, much higher multiples than what, someone might say historically is fair.
So, Vince, you and I met at an investment conference after the great Tyrone Ross gave a very fiery speech about charity and giving back to the community. And I know, we've talked about this, that legacy and giving back to the community is extremely important to you. Why is that? Why is it important to you? And why are you putting so much effort into incorporating that into your career?
Yeah, so, I don't know when, maybe it was about 7 years ago. I don't know what really lit the fire under me, but, I decided to start a charity program at my work. That's where it initially came from. Like we, as a smaller independent firm, didn't really have a charitable program. I said, hey, it's a good way to network and do other things, right? So let's, pick some good charities that are doing good things in our community. And so I sort of led the group of 3 other individuals, and we began to go out in the community and sort of vet some charities that we wanted to get behind and give money to. And one of them in particular was Maggie's Wigs for Kids. Maggie Varney is the executive director and CEO over there. And we went and visited her, and, I think that's where I connected with empathy. So I think that's what you need to, a lot of people need to connect with is empathy. And that's to put yourself into other people's shoes, or at least imagine it, right? And also to realize, I think we're all 1 or 2 mistakes away from, or unfortunate circumstances away from needing help. So you never know when you're going to need that help. And wouldn't it be great if these organizations were there for you? And, something that she said in the meeting when we were, interviewing her and understanding whether or not we wanted to, get behind Maggie's Wigs for Kids was, you can give back in a multitude of ways. You can give your time, your talent, or your treasure. So time, volunteer, treasure, just donate money if you don't have the time, or your talent, loan your skills on the board, right? So give ideas, just help from a big picture avenue, right? And just use your mind to help these nonprofits. So consult almost, right? So those are 3 ways you can give back. I'm trying to do all of those. And I think it's also important, just from the standpoint as years have gone on, I think the political spectrum, I think people, I hear a lot of people just complain about politics or what, the Democrats aren't doing for them or what the Republicans aren't doing for them. And I think at the end of the day, I have a little more idealistic or libertarian view. I know it's not perfect strategy to follow either, but it's on you. The only way your community gets better is you. And so I firmly believe that. I firmly believe that if you go to work every day or you just stay in your home and you're not reaching out beyond your own family, nothing's really going to get better because there's always somebody that needs help. So to be able to just go a little bit beyond that through one of those avenues, time, talent, or treasure, allows your community to get better.
And that was Maggie's Wigs, WIGS?
Yes.
And that's for kids with cancer?
Yeah, so Maggie's, she basically started, I think 20 years ago, basically making wigs for kids. And the way that happened was she herself had cancer. She was a beautician by trade. And she met a girl that was 15 years old that had cancer. And, she didn't like the way she looked. I had to shave her head. And she's like, well, why don't you just get a wig? Well, they don't make wigs for kids, because their heads grow every year. So it's very costly and time intensive. So every year, if you're 5-year-old and you get cancer, leukemia, or whatever, and you have your head shaved, they make you the wig, and it's only good for that year because when you're 6, if you still have it, your head's grown, and so you need a new wig. And so she went down this mission of finding a way to make wigs, and she was able to find different avenues of how to get the cost done, and she has everyone donate their hair. Right, you always see people donating their hair. She gets hair donated, I think, from 60 some countries, something like that. And probably it might even be more, but I mean, all over the world. And she found a company in California that can, custom make these wigs for a lot cheaper than a lot of places willing to. So she just found a company that cared and can make them for a lot cheaper. I think typically the cost of a wig would be around $3,000. And I think she gets them made for more like $800 to $1,000.
That's incredible. And I know now with a lot of your charity work, you're really focused on financial literacy. Why is financial literacy particularly important?
Yeah, so obviously I'm in finance and I see it every day with all walks of life coming through just our firm from a financial planning standpoint, whether, there's people that obviously have money and they want to make more money, but you also have the people that come to you that are in debt. And how did they get there? Or why did they get there? I also, volunteered back in the day at J Finance Park. And, they basically teach financial literacy, nonprofit, for a lot of different inner city schools. And I had the pleasure of volunteering there at one of their Finance Park days where the kids come in there and they're basically assigned a job. And so with that job, they make a certain amount of money and they go around to open a bank account. They have all these little storefronts that have different banks or car companies or, different avenues or restaurant. And they'll go and, get a car loan and buy a car and they got to fit into their budget. But it was eye-opening to me and it ties into, I think, another prescient thing that's in the news a lot, and which is sort of diversity and inclusion and sort of this wealth inequality gap. I was sitting there mentoring, 4 kids, and one of the kids, 9th grader, could barely use a calculator. And it was just striking to me that you could make it that far in school and not really know how to use a calculator well. I mean, it was basic math in 9th grade. And you could see as I've volunteered post that, and I've been involved in different charities, Downtown Boxing Gym is another one in Detroit. Phenomenal charity that's really trying to help the youth keep their nose clean. And boxing is the front, but they're doing more on keeping kids fed, tutoring programs in math and reading in a STEM program. And the schools aren't getting it done, right? And so there's these other outlets that really help these kids out. And it's very eye-opening how poor the schools are in poor communities. And I think a big part of the diversity issues and sort of the social strife we have is just a lack of education and poverty. And it doesn't take a certain race to do that. It's systemic from a poverty standpoint. And going back to financial literacy in general, I have that talent, pass that knowledge on, and I feel as a leader in our community, from being president of the CFA Society, that it's incumbent upon me to promote that within our industry and to make more advisors aware of sort of duty, right? I mean, it's their duty to pass that knowledge on and help the next generation be better financially educated, because you see it in statistics from where banks get their fees from, right? From the standpoint of, I think Tyrone says it, people that are working poor, right? A lot of those individuals are the ones getting overdraft fees. They're the ones with poor credit score leading to higher insurance costs, or higher credit card rates or higher mortgage rates. And so if they just can have some basics of how to manage those aspects of their lives, they can do that much better.
It's incredible how expensive it is to be poor. It's expensive to be poor. When you go to Detroit, your car insurance premiums are 50% higher than they are in the suburbs. You're shopping at, 7-Eleven type stores rather than, a big bulk save, a grocery store. There's countless ways. It's harder to get to jobs when, in Detroit, it's an issue, and not in a lot of cities, but in Detroit, it's an issue where a lot of the jobs are in the suburbs and it's hard to get there. And in order to get there, you have to have the car, which means you have to be able to pay the car insurance, which means also that the roads have to be plowed when it snows. And that doesn't always happen. And, just the number of ways that people who are disadvantaged then become further and further challenged is unbelievable. And in our industry, when you talk about financial literacy and education, well, we have a whole, huge industry in this country of financial advisors and financial planners who address exactly that, but they're compensated typically by assets under management, which means that if you don't have assets under management, if you need the help the most because you're in debt, you're in the red, you're not in the green, then you're going to have less access and you're going to have less options available to you. And it's something that, you and Tyrone certainly talks about, and, you've certainly taken note of and are taking steps to address it. So I think this brings us to the stock market challenge. The Junior Achievement Stock Market Challenge. And of course, this is being run through your role at the CFA Society of Detroit. Tell us what you're doing.
Yeah, so in March, I approached the Junior Achievement Finance Park to form a partnership, in essence, at least a supporter, right? So the CFA Society of Detroit, which is amazing, they weren't aware of us. So we were a great, local investment community tied to the financial community. And we're like, I'd love to help you out. We've got, obviously, investment professionals and finance professionals that would be great to volunteer within your organization. But also, how can we help you spread awareness for financial literacy? And he sort of came back to me a month or two later and said, what do you think about a stock market challenge? And I said, you know what, that's a great idea. Obviously, the feverish pitch right now amongst equity investors, especially on the retail side, with stocks sort of going up every day. And, you got people like Dave Portnoy saying you can't lose in the stock market, it only goes up, right? And so you got a lot of people that are just excited about it. I look back to my teen years when I got interested in the stock market, and that was in the late 90s, right? Sort of the tech bubble. And there's sort of have that excitement around it again, even though I think in the finance professional community, there's a lot more skepticism, but I think in the broader public, there's just a lot of excitement around it. And clearly with Trump being president, he talks about the market every day, right? So we thought, hey, can we, entice people to join our stock market challenge, see who truly is a great investor or trader, from that matter, since it's a 3-month competition. But we thought it was 3 months was long enough to sort of do analysis, and can you find some undervalued companies and find ones that will, outperform over that time frame. But the whole point of it was to raise money for them to promote financial literacy, but also to fund a student-run investment stock challenge. And so in a curriculum around that to help the kids that are part of JA learn about investments, because most of their financial literacy is based around general finance or budgeting and more of managing a budget, not too much on how do you invest money. And that community and people that come from that community, a lot of them are in poverty, and they're not fortunate from the standpoint, I saw my dad investing in stocks. as a kid. So if you don't have parents that are investing, you don't really know investing is a thing. You don't know how to own part of a company. And so I think adding that curriculum piece to the junior achievement curriculum would be great.
It'll be fun as well. I mean, the bragging rights for whoever wins this thing are going to be epic. So I'm in, of course. I'm telling you right now, I'm going super high beta. I haven't decided exactly what the strategy is, but I figure 3 months and a lot of participants, I got to differentiate somehow. But I'm looking forward. It's going to be a lot of fun.
Yeah, so I think in my career, I'd be more on the self-taught side through pure education, reading tons of books. And I think, from that standpoint, I think historically, I wish I had a mentor, but I think looking at it, it opens your eyes to a lot of different possibilities, right? Like when you're under a mentor, they're going to teach you their way. And their way may have worked and may continue to work, but you sort of get like horse blinders on, right? You sort of only see the one way of doing things. And I think I've been fortunate enough to have freedom to wield information from multiple sources, right? If you're willing to sit there and read Ray Dalio's book or read Warren Buffett's book or read Jim Grant, whoever it may be, right? And you get all these different investors or read, investment gurus and where it talks about 15 different great investment managers and their different strategies, whether it's Peter Lynch. And you sort of understand, wow, there's a lot of different ways to be successful at investing. And you can sort of take little pieces from each of them and have a more broader and diverse view of what works and doesn't work. And it also contributes to I think the success of how we've been able to pick good active managers, right? And it's really understanding the different process and not saying, hey, I'm a value manager. And if value is not working, well, you're going to be SOL, right? for many, many years. And you may be, the name's eluding me. If you're the value guy from First Eagle Global, Jean-Marie Eviard in the late 90s, where you've lost 80% of your assets by the year 2000, it's unfortunate. What happened to him, though, is from 2000 2002, he outperformed the market by like 20%, every year. And by 2003, he had all of his assets that he lost back because of his performance. But none of his investors got any of his good performance. Right. So it's understanding, what certain people's belief systems are. And I think it helped me understand not to have too much of a pigeonholed view.
Mm-hmm. Yep. No, I love that. And I've been critical sometimes of, modern investment there. I guess, it just seems like there's not a lot of creativity, at least on the quant side. There's not a lot of curiosity or creativity to new approaches. You got the quant side with the French factors, and that's like etched in stone. You've got your Ben Graham crowd and your value managers, and so many, and then you've got your index investors, and so many people fit so firmly in one bucket and just don't seem to have that flexibility to be able to adapt or to be able to move or take, the best from here and the best from there. So it's, to have that understanding of all the different disciplines, yet be open-minded and nimble within them, I think is a tremendous advantage for you and for your clients.
Yeah, I think it's the old adage of there's many ways to skin a cat, right? So I think from that standpoint in investing, you can be successful a lot of different ways. I think the main thing is to have discipline in whatever it is you do, to be committed, because I think different strategies come in and out of favor.
Or else you're a First Eagle client that went out at the wrong time and went back in at the wrong time and missed the whole good run.
Correct. So that's why it's be committed, whether you're especially a factor investor, right? All of those premiums are realized over a decade usually. When you compare any individual factor versus, we'll call it traditional market cap-based indexing, they will outperform over a much longer time frame. And what we also look at when we're building portfolios, it goes back to sort of behavioral investing, which is, can you keep the client in the portfolio or in the investment strategy the whole time? And you primarily do that by paying attention, in my mind, to tracking error. Because if you're benchmarking yourself to something, you can't get too far away from it. And as bad as that sounds, from benchmark hugging or whatever, it helps clients' behaviors because they're going to hear in the news S&P 500 or they're going to hear in the news NASDAQ 100. And yes, you have to remain disciplined. You have to remain more balanced, as I said earlier, but within reason, meaning your clients won't stay with you or they won't stay within the strategy. They will find something. I live it every day because I deal with primarily the retail investor, and it's hard to keep them committed. So you have to be very cognizant of not being over your skis different.
Yeah, I mean, and that's not just
even
for
if
retail.
it works
Right.
over time.
Sure.
In the short run, people will give up on it.
It's not just for retail, it's for professionals too. Look, my reverse cap strategy. So I launched this fund, the reverse cap ETF. It's the S&P 500 weighted by the reciprocal of the market cap. And we're trying to extrapolate the equal weight premium or small minus big within large cap. And 2 years from the point that we launched it were the worst 2 years for the strategy in the history of S&P data. Literally, there was no rolling 24-year period in the entire history. And, my hairline is lost an inch because of it. It's been stressful, but, it's exactly that. You have to keep the long-term view and say, over the long term, the factor of mean reversion, the factor of small cap outperformance, the reason why, we did this in the first place, those reasons haven't been invalidated because a couple FANG stocks went on a run for a couple years, and you have to have that conviction. But it is hard to do. It is very challenging.
Yeah, I mean, on that, I think that's also a big, problem, really, is the magnitude of the outperformance of some of the large caps and the FANGs in general. And, there's been a lot of talk. They are very close, and if not monopolies. And, no one's sort of challenged that, right, here in the U.S. And I'm wondering at some point if there are an antitrust. When Apple is bigger than the smallest 2,000 companies, that's an issue for capitalism, because the reason why small caps have outperformed is because you have that entrepreneurialism that develops something new. And that new is a game changer for society, right? And it grows into something large. And so there's that constant turnover. And when large, then eventually more competition comes in and will beat up on the large. Today, the largest companies have such a dominant position that it's not allowing capitalism to really work. And when you don't allow companies to fail, meaning the Fed buys junk bonds and other things and starts buying bonds in the corporate bond market, you're not allowing creative destruction, right? And so you need death for birth.
Yeah. I completely agree with that. The leaves fall off in the winter and they come back in the spring, and there's a cycle of things. And, companies that nobody ever thought would fail. Nokia was dominant. IBM in the cell phone space. IBM was dominant. GE was dominant. These companies, and eventually they decline, and it's a natural cycle of things. And that natural cycle has been impeded now by the ability, I think it's mostly the internet, but it is a lack of antitrust enforcement that has allowed these companies to just grow endlessly. And I think it's net a very bad thing for capitalism and for the market as a whole. I want to talk about persistence. You've got this incredible Ray Kroc quote on your LinkedIn page. You say, "I pride myself on my grit and passion, my unrelenting will to succeed and to see goals achieved." Tell me about that. Tell me about what persistence means to you.
Yeah, I mean, really, it's as simple as never giving up, right? I mean, I'm one of those individuals that sets a goal and I do whatever it takes to see it to fruition. I'm more of a long-term planner. I think that's what sort of alluded to earlier from our investment philosophy. It's not about what happens this year and next, what's going to happen 3 and 5 years from now, what's going to happen a decade from now. And I know it's hard to predict, but it's about planning, really, not predicting. It's making sure that you're on task to meet your ultimate objective. And so if the ultimate objective is not to run out of money, it takes a lot of, in retirement, it's a lot of planning and a lot of management around that. And so, I watched Founder, and actually came across that quote. And I also read a book called Grit. And it talks about one's talent plus passion. And it's really about a grit score. And so how gritty are you? So some people give up easily. So they basically it was an MIT study, I believe. And they basically would test Marines on treadmills, right? And so they would put them on vertical treadmills for 5 minutes or however long they could do it before they gave up. And they would basically determine personality types and how much grit they had by how easily they would give up on this fully vertical, as fast as it can go treadmill. And basically what it came out to was the most talented person always doesn't win, right? And I would say, look at sports teams, right? Local here from Detroit, look at the 2004 Pistons. Nobody thought they had a chance of beating the Lakers with Shaquille and Kobe, right? But they're just so gritty. They had an unmatched work ethic to succeed, right? They outworked the Lakers in every aspect, and it beat talent. And that's basically, another quote from Wade Kroc was, there's a lot of super educated, super talented people, but he'll take a hard worker 9 out of 10 times is going to beat him, because a lot of times the talented, educated people get lazy in their work ethic. And so I pride myself on trying to be educated and talented, but also to never let my work ethic slip. And so I'm going to be as persistent as possible to achieve whatever goal I set for myself.
That's amazing. Vinny, I like to close with this question, which is, tell me an obstacle that you've had either in your personal life or your career that you either found a workaround or that you just persisted through.
I don't know if it's the most, but it's just first thing that comes to my mind, I guess, is just obtaining the charter, right? My charter wasn't that, it was difficult. I think, starting out level 1, I didn't take it as seriously as I guess I needed to. I was always a pretty good test taker, very good student. And I thought, man, I'll read through these books, I'll take this test and, no big deal. And I failed level 1, the first time. And, nothing like failure to push you even harder. And so I've always sort of done that in my life where, I may fail at something first, but I'm not going to fail again. And after that moment, 3-4 months of my life every year was shut down where I did nothing but study for that CFA charter. And, so failing level 1 the first time, but then passing levels 1, 2, and 3 after that was, the success factor, right? So it's understanding your initial challenge, right? And overcoming those hurdles, right? And a lot of people, I've heard of people that have failed, might have had a more difficult path than that, but that failed, level 2 or whatever, 3-4 times and have still made it on. And that's that persistence factor that, really allows people to achieve things.
Thank you. Thank you for that. Thank you for coming on the podcast. Where can people learn more about working with Advance or joining the CFA Society of Detroit?
Yeah, so Phil, I really appreciate you having me on. And, for Advance Capital, it's www.acadvisor.com. And the CFA Society of Detroit is cfadetroit.org.
Okay, guys, this is the Junior Achiever Stock Market Challenge. I am in it, and Vince is in it, of course. And let's see if you guys can beat us. But sign up. It's for a great cause. And thank you again, Vinny. Thank you to our listeners for your time and attention. We'll be back on next week.
Thank you.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.